Welcome back, everyone, to another deep dive. Today, we are diving into a topic that I think a lot of you have heard of, but maybe don't know that much about, and that's shareholder activism.
Yeah, that's right. This is a really interesting story that kind of goes back over 100 years. We're going to be talking about everything from individuals who took on things like railroad monopolies, all the way to, today's world of high-stakes hedge fund battles,
Hmm.
all using excerpts from Dear Chairman, Boardroom Battles and the Rise of Shareholder Activism.
I love that title, Dear Chairman. So we're going to kick things off with a name that I think a lot of you know, and that's Benjamin Graham, the father of value investing. I'm not sure that that's the image that comes to mind when I think about a corporate raider.
No, not really, no.
Hmm.
And what's really interesting about Graham is he actually became an activist kind of by accident. You see, he was doing a lot of research on railroads, and he discovered all of these really detailed financial reports that Wall Street had basically completely overlooked. And these were reports from pipeline companies that were being submitted to the Interstate Commerce Commission, but they were a trove of information.
Oh, interesting. So they were required to submit these, but no one was really paying attention.
No, they were not really paying attention, and this was right up Graham's alley.
So while everyone else is busy chasing rumors, he's looking at the actual data. I like it.
Exactly. Back then, everyone on Wall Street was focused on speculation, not this careful analysis of what a company was actually worth. So Graham saw a huge opportunity to unearth all of this hidden value that everyone else was missing.
And that led him to Northern Pipeline.
It sure did. So through his research, he discovered that Northern Pipeline was sitting on a mountain of cash,
Okay.
but they weren't sharing it with
They
shareholders.
were hoarding it.
Yeah, essentially. So Graham, he'd acquired a pretty sizable chunk of the company, and he starts pushing them to issue a special dividend to return this excess cash to shareholders.
So is this where things get a little contentious?
Oh, yeah.
I imagine they're probably not too happy about this.
Well, they basically told him to mind his own business.
Oh, really?
Yeah. They said that, running a pipeline is far too complex for some, outsider like him to understand. They said if he's unhappy, he should just sell his shares.
Okay, so they called his bluff.
Yeah, well, not exactly. This is where Graham really kind of takes things up a notch. So he launches what's known as a proxy fight.
Okay, a proxy fight. So what is that?
Yeah, so essentially it's a battle to win over enough shareholder votes to elect your own people to the company's board of directors.
Okay, so it's like a mini election for control of the company.
Exactly. And in this case, Graham, with all of his meticulously researched arguments, he won the day. And this was a landmark victory. It showed that even a lone investor with some really solid research could challenge these really entrenched corporate powers. And this was something that kind of reverberated throughout the history of shareholder activism.
David and Goliath, I love it. Okay, so that's one for the little guy. Now let's fast forward a couple of decades to the golden age of railroads. We've got a guy by the name of Robert Young, and I'm sensing he takes a bit of a different approach.
Yeah, he did. So this is the story of the New York Central Railroad, which had been this titan of the industry, but was really struggling under what Young saw as just this really stale and bureaucratic management. And Young was this real charismatic outsider. And he understood that to win over shareholders, you need more than just numbers. You need a compelling story.
So how does he do it?
Well, he painted himself as the champion of the everyday shareholder. He accused that existing management of everything from nepotism to just incompetence, and he really knew how to connect with people emotionally,
Interesting.
appealing to their sense of fairness and desire for change.
It's amazing how much things haven't changed.
It really is. But what set Young apart was his marketing savvy. He came up with this whole campaign called Piggyback, and this promoted his idea of modernizing the railroad by putting trucks on trains.
Wait, so he's talking about intermodal transport way back then.
Yeah, it was really forward-thinking.
That is really forward thinking.
He even had these really eye-catching ads with model trains that were carrying these miniature trucks, and it just really caught the public's imagination.
Wow, so he really ran like a full-on media campaign, huh? That's next level shareholder activism.
It was. I mean, think about it. You've got public debates, radio appearances, even direct mail campaigns. He went head-to-head with the existing management, really battling for the hearts and minds of those shareholders.
Does he pull it off?
In a stunning upset, he won. And despite being, a profitable company, the New York Central was shaken. This was huge. This victory really signaled a massive power shift. because now even profitable businesses were vulnerable to these shareholder revolts if they were perceived as being poorly managed or out of touch.
It's all about perception, right?
Exactly.
Okay, so in a few short decades, we've gone from meticulous financial analysis to full-blown media blitzkriegs. Just goes to show you there's more than one way to shake up a boardroom.
That's right.
But before we get to the modern era of corporate raiders and hedge funds, let's talk about a story that sounds too crazy to be true.
Okay.
And that is the Great Salad Oil Swindle.
Oh, yeah. Now, this one's a wild ride. I mean,
Yeah.
we're talking about fraud, deception, and just the consequences of unchecked trust. And it all revolves around this guy named Tino DeAngelis, who built a massive empire on salad oil.
Okay, now hold on. How do you even begin to build an empire on salad oil? I need to know more about this.
Well, it turns out you don't. You build it on the illusion of salad oil. So DeAngelis, he managed to defraud all these companies,
Yeah.
including American Express,
Oh, no.
by convincing them that he had these massive reserves of salad oil, when in reality, his tanks were mostly filled with seawater and a bunch of other things.
Oh, no, this is going to get messy.
It did.
And American Express got caught up in this.
Hook, line, and sinker.
Uh-huh.
They issued all of these warehouse receipts for his company's oil,
Mm.
basically vouching that it actually existed.
Oh, no.
And so when the fraud was exposed, American Express was on the hook for millions in losses.
Talk about a shareholder's worst nightmare, right? Your investment goes up in a puff of, well, not even smoke, but cooking oil.
Pretty much.
Yeah.
I mean, it was a disaster. American Express, their stock plummeted. Investors were furious. I mean, the company's whole reputation for trustworthiness was shattered.
Yeah, that's a hard one to come back from. So what happens next?
Well, enter Warren Buffett.
Of course.
In the midst of all the panic, Buffett saw opportunity. He recognized that American Express's core business, which was traveler's checks and credit cards, was still really strong.
Mm-hmm.
And so for him, this whole salad oil scandal was a temporary setback, not some sort of fatal blow.
Classic Buffett, right? See value where others see disaster.
That's it. So he goes against the grain, invests heavily in American Express when everyone else is selling, and this contrarian bet pays off big time.
Mm.
As the company recovers, Buffett's kind of further cements his reputation for seeing the bigger picture and understanding a company's intrinsic value.
So what's the takeaway here with this whole oily escapade? I mean, we've seen how activism can challenge mismanagement, drive positive change, but the American Express case, it really highlights a different aspect. This is about holding companies accountable for something as basic as trust.
You got it. I mean, shareholder activism isn't just about profits. It's about demanding that companies act ethically and responsibly. And sometimes that means asking the tough questions and demanding that accountability, even from these titans like American Express.
And it's about doing your due diligence. I suspect that would have revealed a whole lot of seawater in those oil tanks.
Maybe so.
But now things are about to get really interesting because now we're moving to the Wild West of 1980s corporate raiding. We're going to encounter a whole new breed of activist investor.
That's right. Buckle up, because next up, it's barbarians at the gate. So imagine this, a financial landscape where fortunes are made and lost literally overnight, where corporate raiders, they're circling these undervalued companies, I mean, just like wolves.
Okay, yeah, I'm getting the picture. This is the 1980s. This is barbarians at the gate. These aren't your grandfather's activists, are they?
No, not quite.
Mhm.
This is the time of high-stakes, high-leverage takeovers, and they were fueled by junk bonds.
Okay, junk bonds. Now, there's a term that I feel like that's synonymous with the 1980s, but for those of us who weren't there, break it down. What are we talking about?
So junk bonds, these were bonds that were considered non-investment grade. So that means that they promised these really high returns, but they also carried a very real risk of default.
Risky business.
Yeah, and they were really pioneered by this financier, Michael Milken. And this completely changed the game for these corporate raiders.
Okay, so Milken's providing the ammunition, and then you've got guys like Carl Icahn. He's the sharpshooter.
That's a great way to put it. And in fact, one of the most famous battles of this era was the battle for Phillips Petroleum.
Oh, okay, yeah. And this is the one involving T. Boone Pickens, right? Another big name from the 80s, synonymous with this whole corporate raiding.
That's right. So Pickens, through his company, Mesa Petroleum, he sees that Phillips Petroleum is undervalued, and he believes that management is lagging. So what does he do? He launches a hostile takeover bid.
So what are we talking about here? We're talking about green mail, poison pills, all that kind of stuff.
Oh, yeah, all of that. So green mail, that's essentially a bribe, right? The company pays off the raider to go away, buys back their shares at a premium. A poison pill, that makes the company less palatable for takeover, and it makes it prohibitively expensive to acquire that controlling stake.
So these are defense mechanisms.
Exactly. And Phillips Petroleum actually used both of these tactics against Pickens.
So where does Carl Icahn fit into all of this?
Well, Icahn, never one to miss an opportunity, he sees this whole fight for Phillips as a chance to make his own move. So using a combination of his own capital and, importantly, junk bond financing arranged by
Oh,
Milken,
here he is.
he launches his own bid for Phillips.
So with Milken backing him up, I mean, Icahn's a force to be reckoned with here.
Oh, yeah. And it wasn't just individual investors like Icahn who were shaking things up. The battle for Phillips Petroleum also highlighted the rising influence of institutional investors.
Okay, so who are we talking about here?
We're talking about entities like pension funds, mutual funds, these big players who held huge chunks of shares in companies like Phillips.
So it's not just about individuals anymore. The big players are getting involved.
Exactly. And these institutional investors, they realized they had real power to influence these corporate decisions, so they started to become much more vocal, demanding better performance and corporate accountability. And this added a whole new layer of complexity to these takeover battles.
So what ultimately becomes of Phillips Petroleum?
Well, neither Pickens nor Icahn actually succeeded in taking it over. But the fight wasn't for nothing. I mean, Phillips, they ended up restructuring. They took on more debt, much of it financed by, you guessed it, junk bonds.
Okay.
And they buy back shares to boost their stock price and make it less attractive as a takeover target.
So even in defeat, these raiders, they forced Phillips Petroleum to change, which ultimately benefited, you'd think, all the shareholders.
That's right. So yeah, the 80s, I mean, we remember them for these barbarians at the gate, but this era also forced corporate America to become more efficient, more responsive to these shareholder concerns. And it really paves the way for this new breed of activist investor hedge fund managers. They're going to wield even more financial power and influence.
And that brings us to Daniel Loeb, the master of the 13D flamethrower. So tell me, what is a 13D flamethrower?
So a 13D, this is a regulatory filing that investors have to submit when they acquire a significant stake in a company. And Loeb realized that he could use these filings as a very public platform to air his grievances about a company and really try to rally other shareholders to his cause.
Oh, so he weaponized bureaucracy. That's really thinking outside the box.
It was brilliant. And these letters that he would write, these weren't just some boring financial documents. I mean, they were scathing, they were witty, they were often brutally critical of the companies that he was targeting. He used humor, he used outrage, even sometimes personal attacks to really expose what he saw as incompetence or mismanagement.
I'm just imagining these CEOs reading these letters over their morning coffee, just like, oh man, rough way to start the day. So Loeb, he's not afraid of a fight.
No, not at all. In fact, he took on everyone from Bill Stieritz, the legendary CEO, to the leadership of a company called Stargas. His battles became legendary.
Okay, so let's talk about the Bill Stieritz battle. What went down there?
So Stieritz was already famous, right? He transformed Rolls and Purina. And so he's now the chairman of both Ralcorp and Agrobrands. And when he announces his plan to merge the two companies, Loeb, he sees red flags everywhere.
Red flags for shareholders.
Exactly. He argues that this merger undervalues Agrobrands' core business. He thinks that Stieritz is basically trying to pull a fast one on shareholders.
So does he fire up the 13D flamethrower?
He does. And in his very first 13D letter, he comes out swinging, accuses Stieritz of self-dealing, putting his own interests ahead of Agrobrands shareholders.
That's a bold move for a first-timer.
It was a power move. It got Wall Street's attention. And here's the kicker. Just weeks after Loeb files this 13D, another company, Cargill, comes in with a much higher offer for Agrobrands.
Oh, wow. So he sniffs out a bad deal and then exposes it for everyone to see, and then Cargill swoops in. That's right. Massive win for Loeb. Massive win for Agrobrands shareholders. They got a far better price thanks to his intervention. And Loeb walked away with this reputation as a force to be reckoned with.
He's like the shareholder whisperer.
Right.
Okay, so speaking of which, let's talk about the battle with Stargas. What juicy details came out in that 13D letter?
So the Stargas case really showcases Loeb's, flair for the dramatic, right? So he believed that Stargas, which was a propane distributor, was significantly undervalued and just terribly managed.
Okay.
So he fires off this letter that was as scathing as it was entertaining. He publicly accuses the CEO of treating the company like a personal piggy bank, using it to extract this excessive salary and protect himself from lawsuits. He even called out the CEO's 78-year-old mother for being on the board of directors.
He went there?
He went there. questioning her qualifications and suggesting she was only there to protect her son.
Oh, man.
But amidst all this sharp wit and these personal barbs, Loeb was raising some serious governance issues.
Right. Excessive executive compensation, lack of board independence, just a disregard for shareholder interests.
So did it work? Did his tactics work?
Well, the letter, you can imagine, caused a huge stir. It was a PR nightmare for Stargas. Shareholders were outraged. It was a field day for the media, and the company was forced to make some changes.
I bet they instituted a no more embarrassing 13D letters policy after that one.
Right.
So what kind of changes are we talking about? What did they actually do?
So they ended up adding new independent directors to the board,
Okay.
which meant less influence for the CEO and his inner circle. They also sold off some underperforming assets, so they streamlined their business. And hopefully this boosted shareholder value.
So Lobub, in his own way, actually spurred some positive change with these tactics.
Yeah, he did. But the Stargas case, along with many others, really started this debate. How much is too much? Can shareholder activism, even when it's well-intentioned, go too far and actually harm the very companies it's trying to improve?
Yeah, it seems like there's a very fine line to walk there between pushing for positive change and then shaking things up so much that it just backfires completely.
Absolutely. And that brings us to the cautionary tale of BKF Capital.
Oh, okay.
This is a case where activist pressure, seemingly aimed at improving the company, arguably led to its downfall.
Yeah, so BKF Capital, they were an investment firm managing money for like wealthy individuals and institutions.
Okay.
And they had a really good reputation, really talented team of investment professionals who were, as you might expect, very well compensated.
So were they ripe for a shakeup in the eyes of an activist investor?
Seems like it. So mid-2000s, this activist hedge fund, Steel Partners, led by Warren Lichtenstein, they set their sights on BKF.
Okay.
Their argument, the company's undervalued, poorly managed, and that its compensation structure was way too generous.
Classic activist arguments,
Yeah.
right? Cut costs, boost shareholder value.
Exactly. But what makes BKF so interesting and honestly kind of tragic is that those, seemingly standard activist demands, they completely backfire. Wait, so by trying to improve the company, they actually destroyed it?
Yeah, that's the argument. See, BKF's most valuable asset was its people. They had these highly skilled investment professionals, and their compensation was directly tied to their performance. So this incentivized them to deliver those exceptional returns.
Right, makes sense.
Well, when the activists pressured BKF to cut costs, one of the point things to go was that performance-based compensation.
Oh, so they killed the goose that laid the golden egg.
Pretty much.
Yeah.
The talent, they start leaving. They're demoralized by the changes. Better opportunities are calling elsewhere. And so with their star players gone, BKF's performance tanks.
Yeah, it's a classic case of not really understanding what makes a business tick. You can't just slash and burn your way to success, especially when human capital is everything.
Exactly. The BKF case, it's a stark reminder that what works for one company might be disastrous for another. And it underscores a really crucial point. Even with the best of intentions, activism can have unintended consequences.
It's like performing surgery with a chainsaw. Sometimes a scalpel is the better tool for the job. So where does this leave us? We've seen heroes, villains, everything in between. What's the takeaway?
Well, it's clear that shareholder activism is powerful. It has the potential to hold corporations accountable, drive positive change, unlock value for shareholders. But as we've seen, it's not a magic bullet, and it's not without its risks.
So how do we navigate this complex landscape? As investors, how do we figure out if an activist's intentions are noble, or if they're just another wolf in sheep's clothing?
There are no guarantees. But here's a framework, right? First, look at their track record.
Okay.
Have they consistently created long-term value for shareholders, or are they just squeezing companies for these short-term gains?
So history of sustainable success, that's a good sign.
Exactly. Second, examine their approach. Are they engaging with the company constructively? Are they looking for solutions that work for everyone? Or are they resorting to hostile tactics and these very public attacks that might grab headlines but don't actually help the company in the long run?
So collaboration over confrontation.
Exactly. And finally, think about their motives.
Okay.
Are they laser-focused on those shareholder returns, even at the expense of employees, customers, the community? Or do they take a more holistic view? Understanding that a company's long-term success, it depends on a healthy ecosystem.
So are they just thinking about the bottom line, or are they thinking about the big picture?
That's it.
Those are important questions to ask. So looking ahead then, what does the future hold for shareholder activism? Is this just a passing fad, or is it here to stay?
All signs point to activism becoming even more prevalent.
Really?
Oh, yeah. I mean, several factors are fueling this. For one, the rise of passive investing. People investing in index funds, ETFs, that track the market. It's given enormous voting power to these large institutional investors. But, and it's a big but.
They're not necessarily interested in getting involved.
Exactly. They're often content to just be passive owners, which creates this vacuum that activists are more than happy to fill.
So activists are becoming the voice of these passive investors.
In a way, yeah. Plus, there's this growing emphasis on ESG, environmental, social, and governance factors. Yeah. This is creating a whole new avenue for activism.
So instead of just focusing on profits, they're also pushing companies to be more sustainable, more ethical, more socially responsible.
Yes. And this ESG-focused activism, it's gaining a lot of momentum. It's likely to reshape corporate behavior in the coming years.
It's interesting how the whole focus of shareholder activism seems to be broadening. It's not just about money anymore. It's about values. It's about making a positive impact.
Yeah, and we can't forget about technology. The increasing availability of data, sophisticated analytical tools, it's made it easier than ever for activists to identify those undervalued companies, connect with investors, and launch these really targeted campaigns.
So activism is getting smarter, more efficient, more targeted. It sounds like it's definitely here to stay.
It's a force to be reckoned with,
Yeah.
and it's reshaping the very fabric of corporate governance.
It really is fascinating stuff. Well, this has been an incredible deep dive. We've gone from the origins of shareholder activism with Benjamin Graham to the high-stakes battles of the corporate raiders like Carl Icahn, all the way to the rise of hedge fund activism and figures like Daniel Logue.
We've seen the highs, the lows, everything in between.
We really have. And we've learned that while it can be a powerful tool for good, it's not without its complexities and its risks.
That's right.
So as we wrap up here, what's the key takeaway for our listeners? What do we really want them to remember?
Be informed, be engaged, understand your rights as a shareholder, do your research, and don't be afraid to hold those companies accountable for their actions. The future really does depend on active and responsible shareholders who demand that transparency, that ethical behavior, and that long-term value creation.
It's about recognizing that every share you own, that's a tiny piece of ownership in that company. And with that ownership comes a responsibility. We need to make sure that those companies are being run in a way that benefits everyone, the investors, the employees, the customers, the community.
Well said. And remember, you don't have to be a Wall Street hotshot to make a difference. Every voice matters, and collective action can move mountains, even in the corporate world.
It absolutely can. This has been the deep dive, taking you beneath the surface of complex topics. Thanks for joining us. Knowledge is power.